Hello everyone. In this video, I will be sharing how I use 5 simple steps to select the stocks in my challenge account. My aim for the challenge account is to compound the wealth steadily. That will be used for my children's educational fund or even retire myself earlier. Therefore, I have stringent rules to select my stocks. If you would like to build a portfolio that can compound your wealth consistently, remember to watch this video until the end, as these 5 steps must be applied together. Hi everyone, I'm Jay from JM Investment Journal. If you are the first timer here, this channel is to share my investing idea, record my investment journal, and to provide a starting point for everyone to kickstart your investing journey. My ultimate aim is to achieve financial freedom and retire myself earlier in the stock market. Please subscribe my channel and turn on the notification bell if you would like to do so too. Just a quick recap. I started my challenge account with USD 5,000 as this is an amount that most people can start with. I will top up USD 500 monthly into this account. This is my current challenge account as on 28 March this year. The account only started for 2 weeks and currently I have 7 stocks in my portfolio. As this is an account for long-term investing, the stocks that I choose to be in my portfolio must give me a peace of mind. For example, allow me to sleep soundly every night. I do not need to monitor it every single day. They will not go bankrupt or manage to rebound after each retracement or market crash. Overall, my capital must be safe if I park my money with them. Important disclaimer. Please note that all the stocks shared in this video is only my opinion and for educational purposes only. They are not stock tips, so please do your own research before investing any money in. Because limited by the length of the video, here I summarize briefly the 5 most important criteria to select the stocks in my challenge account. Step 1. Long-term uptrend. Step 2. Consistently increases of revenue, net profit, and cash flow generated from operation. Step 3. Depth profile and healthy cash flow. Step 4. Economy modes, industrial leader. Step 5. Future growth driver or sunset industry. I will further add one more bonus criteria at the end of the video. First stock, Apple. I get my Apple share free when Food to Singapore is having a promotion. By the way, I recently learned that the promotion is still ongoing to receive an Apple share. If you have not opened the account yet, please use the link provided in the description or watch this video on the top right corner here. Let's back to the story. Step 1. Long-term uptrend. As we are investing for long-term, I would choose to look at 10 years weekly chart. This is a 10 years chart for Apple. Do you see the red line? This is simple moving average for 200 weeks. In this video, I will just call it MA200. As long as the price is above MA200, it is in a long-term uptrend. Since 10 years ago, Apple is consistently above MA200. Thus, it passes the first criteria. As a comparison, some cyclical stocks require more monitoring, and they are not the best choice to invest for long term. Of course, they are still profitable, but that is for different story and strategy. For example, I won't park my long-term money into the stock like this and like this. Step 2. Consistently increases of revenue, net profit, and cash flow generated from operating activity. We want the company to make money. We can look for the company revenue and net profit from their income statement. Cash flow generated from operating activity can be obtained from their cash flow statement. Revenue is the sales that brought money into a company by its business activities over the period. Net profit is a profit of a business after deducting expenses such as cost of goods sold, administrative expenses, operating expenses, depreciation, interest, and taxes. Cash flow generated from operating activity indicates the amount of cash of a company bring in from its ongoing regular business activities. For my study, I am using shareinvestor.com to extract the financial data that I need. I'm a premium member there as I found that it is very useful for my analysis. If you would like to sign up, feel free to refer the link I provided in the description. This is a screenshot on the data that I'm extracting to analyze Apple's earnings. The first one is revenue. I extracted 10 years data from here. I also extracted net earning here. Please take note that for the net profit, right, we can also extract the data of earning per share. Lastly, I also extracted the data for the net cash generated from operating activities. After the data is extracted, I will plot them on a spreadsheet. This is an example of the data that I put on the spreadsheet. Then we can plot the graph. This is the chart for revenue, and this is the chart for net profit and operating cash flow. Overall, Apple managed to increase its revenue, net profit, and operating cash flow consistently. Therefore, Apple also passes my second criteria. In addition, I also will check if the company could beat the earnings consistently. I use a website called Alpha Query. This is the earning chart that is extracted from the Alpha Query. How to read this chart? Each quarter, a public listed company is required to publish their financial results. Before that, a consensus forecast number is normally will be shown. When the company publishes a better than the expected earnings, we could call this earning beat. We would like to have a company that could beat the earning or actual EPS more than the estimated EPS consistently. I will post the link in the description too. From the earning chart, Apple managed to beat the earning almost 100% since year 2015. As Apple manages to increase its net profit consistently every year and beat the earning consistently, in general, company valuation will increase when the net earning increases consistently. When valuation is higher, the stock price will also go higher as well. The conclusion, Apple passes my second criteria perfectly. Third step, debt profile and healthy cash flow. For the debt profile, generally, I would like to see the company has a conservative debt policy. We do not want to park our money in a company that may go bust because of default, right? The company has to be sustainable during economic downturn too. The company needs to have a current ratio of more than 1. The current ratio is a liquidity ratio that measures a company's abilities to pay short-term obligations or those due within 1 year. Next, I would like the company to have a current assets that is more than the current liability. Current asset is cash or other assets that are expected to be converted to cash within a year. Cash is like a blood flow of a company. Current liability is company's short-term financial obligations that are due within 1 year. The ratio has to be more than 1. Lastly, debt to equity ratio should be smaller than 1. It is used for the assessment of financial leverage and soundness of a company. We are not going to go into details for this, but by principle, we would like to have the ratio of smaller than 1 so the company is less risky. For the debt profile, we only need the figures from the last report. Thus, we could easily find them at FinWith. I will paste the link in the description too. First, go to FinWith, type the ticker in the search box, then we can easily find both current ratio and debt to equity ratio, as shown here, the red color box. From the table, Apple has a current ratio of 1.2 and debt to equity ratio of 1.69. If we further scrolling down, click on the balance sheet. Then we could extract the latest data of the total current assets and total liabilities of Apple. Based on the figures here, the ratio between total current assets and total current liabilities is 1.36. Summary of the debt profile of Apple. Current ratio of 1.2, more than 1. Pass. Current assets to total current liability ratio is 1.36, which is also more than 1. Pass. However, the debt to equity ratio is 1.69, which is more than 1. Fail. As it passes 2 out of 3 criteria here, Apple debt profile is considered healthy. Step 4. Economy mode or industrial leader. If you are an Apple user, most likely you will stick to it as it has a high conversion cost. For example, it uses its own iOS platform and it also creates ecosystem like MacBook and Apple Watch. Therefore, it's not easy for you if you want to change your brand to like Android, right? The easiest way to check if the company is industrial leader, we just need to compare its market cap with the company in the similar industry. With a market cap of almost 2 trillion, Apple is definitely the market leader in its industry. Step 5. Future growth driver. I am not going into the details for this part too. If time allows, I will prepare a separate video on this company. Minimally, the company should not have its major business involved in a sunset industry. Sunset industry is an industry in decline. For Apple, it does not only involve in improving its current products to suit the current trend of the user's need, it also involves in other industries that would be disruptive to the current technology. 2 examples are Apple Car and AR glasses. If you prefer to look on the data, we could look for the EPS next 5 years from the FinWith. It is the estimation long-term growth rate of the company. We want the growth rate is positive. In this case, Apple has a nice double-digit growth rate of 14.69%. Here are the summary for Apple. Step 1. Long-term uptrend. Pass. Step 2. Consistently increases of revenue, net profit, and cash flow generated from operation. Pass. Step 3. Debt profile and healthy cash flow. Pass. Step 4. Economy mode. Industrial leader. Yes. Step 5. Future growth driver. Yes. As it passes 5 out of 5 criteria here, I will be happy to invest in Apple. By the way, identify a good company and decide an entry point to buy the share is very different. I am not going into the details for the entry. Please refer to this video on the top right corner on how I decide my entry for a stock. Next stock is Costco. The ticker is COST. Costco is in the consumer discretionary sector. Let us analyze the 5 steps of Costco. Step 1. Long-term uptrend. It is pretty clear that Costco has a nice long-term uptrend since 10 years ago. It passes the first criteria. By the way, I did share on my Telegram group about my opinion on Costco and Pepsi. They are both oversold on 9th of March. Although I do not provide stock tips, but the information here may provide you some insight. Since then, Costco has a nice run of around 12%. Feel free to join my Telegram group so we can discuss the stock and the investing idea together. The link is provided in the description as well. Step 2. Consistently increases of revenue, net profit, and cash flow generated from operation. This is the table for the income trend for Costco. Let us look on the chart, revenue chart, and net profit and operating cash flow chart. Costco consistently show increase of revenue, net profit, and operating cash flow since year 2012. It passes the second criteria too. If we further look on its earning history, Costco could beat the earning 15 out of the 23 last reported earning. It is not fantastic, but still acceptable. For Costco, what is even more important is its membership renewal rate, as this is their main source of revenue. From the website Statista, Costco has a consistent increase of card holders since year 2014. This signifies that it has a superb renewal rate. Step 3. Debt profile and healthy cash flow. From the table, Costco has a current ratio of 1 and debt to equity ratio of 0.49. As the current ratio is quite neutral, let us see its ratio of the current assets and the current liability. Overall, Costco has healthy debt and cash profile, and it passes the third criteria. Step 4. Economy modes or industrial leader. Costco is the industry leader too. Some of you may ask, why not compare Costco with Walmart, as both are also discount retailers that sell grocery items as well as general merchandise products. In fact, their business model is very different. Costco sells items in bulk and it offers membership to enjoy the discount. Costco profits from its membership offers. Walmart is like a giant supermarket that opens to everyone. Walmart draws large number customers from the middle and lower income segment. The faster and more items transacted out, Walmart will get more revenue. This is the net profit and operating cash flow for Walmart. Personally, I prefer Costco because it has a better trend on net profit and operating cash flow. However, please also note that Walmart provides a more better dividend yield compared to Costco. So it depends on which company suit your needs. Step 5. Future growth driver or sunset industry. Not only Costco has a steady membership growth and stable profit, Costco has also an increasing focus on its e-commerce appearance. Now, online shopping of e-commerce is the trend, right? Last but not least, EPS next 5 years for Costco is 8.64%. This is a very good value. Summary for Costco. Step 1. Long-term uptrend. Pass. Step 2. Consistently increases of revenue, net profit, and cash flow generated from operation. Pass. Step 3. Debt profile and healthy cash flow. Pass. Step 4. Economy mode. Industrial leader. Yes. Step 5. Future growth driver. Yes. Before I continue to the next stop, I hope you learned something new here, as we really spend a lot of time to deliver the best to you. Plus, we are going to prepare more videos to help you to kickstart your investing journey. I hope you could click on the like button to motivate us more. If you have not subscribed to our channel, please click on the subscribe button and turn on the notification bell to get our latest updates. If you think that this video could help others, please feel free to share it too. Next stop is Taiwan Semiconductor Manufacturing Company, or TSMC. The ticker is TSM. Let us first see the chart. Apparently, it is on a very nice uptrend since 10 years ago. Step 2. Consistently increases of revenue, net profit, and cash flow generated from operation. This is the table for the TSM. TSM has the so-called textbook example of consistent growth in revenue, net profit, and operating cash flow. The trend is very nice. This is definitely a pass to the step 2. TSM could also beat the earning consistently with more than 80% since year 2015. Step 3. Debt profile and healthy cash flow. From the FinWith table, TSM has a current ratio of 1.8. Its debt to equity ratio is very low as well, only 0.2. Total current assets or total current liabilities ratio of TSM is 1.77. With a current ratio of 1.8, debt to equity ratio of 0.2, and current assets to current liabilities ratio of 1.77. How do you think the debt profile of TSM? Step 4. Economy mode industrial leader. Can you name some famous companies in the semiconductor sector? Let me name a few. NVIDIA, Advanced Micro Devices or AMD, and Qualcomm. It seems that TSMC does not have economy mode, right? In fact, TSMC is focusing on semiconductor foundry. It is a business that operates for the purpose of fabricating the designs of other companies. It means that other company designs the chips, but TSMC produce it. Thus, NVIDIA, AMD, and Qualcomm are actually TSM's customer. Apple is also one of the biggest customers of TSM. So it does not matter which company will win in the very competitive field of semiconductor industry, because TSMC is at the very upstream. So whoever wins, right, TSMC will be benefit from it for sure. This is a pie chart from Counterpoint Research on foundry capacity share. Apparently, TSMC is the market leader. Step 5. Future growth driver. What happens if the demand is more than supply? The price will going up, right? If you Google chip shortage, you will manage to find a lot of news or report on the severe shortage of chip has caused a disruption on many industries, such as automotive and computer. In addition, the demand on the chip will be higher and higher because of the advancement of 5G technology, self-driving car, artificial intelligence, smart home appliances, and other devices that requires higher end technology. The only limitation is whether TSMC managed to further increases its production capacity. It has been at full capacity for a few months already. Last but not least, TSMC is going to start the production of 3nm chip. No doubt that the future driver for TSMC is really bright. From the film feed, the EPS next 5 years from TSM is as high as 24.5%. Summary for TSM. Step 1. Long-term uptrend. Pass. Step 2. Consistently increases of revenue, net profit, and cash flow generated from operation. Pass. Step 3. Debt profile and healthy cash flow. Pass. Step 4. Economy mood. Industrial leader. Yes. Step 5. Future growth driver. Yes. We will continue the analysis of other stocks in part 2. Please remember to subscribe our channel and turn on the notification bell so you could receive our update as long as I publish the video. Thank you very much and see you in part 2.